Hello, everybody. This is Professor Tchaikovsky, and welcome. I got one of my students asked me a question. It's actually a great question about what exactly happens. What are the journal entries for when a company goes bankrupt? So, just to kind of take a little bit of this presentation is copyright 2024 by Bennett Tchaikovsky. Please, this is for your use only, et cetera, et cetera, et cetera. Please don't repost. In any event, let's go ahead and take a look at this. So the question is, a company goes bankrupt. What are the year-end adjusting entries? And the answer that they're giving is operating expenses and then crediting the allowance for doubtful accounts. Okay, but before we get there, let's talk a little bit about how accounts receivable works, right? So accounts receivable is a balance sheet item. When we report it, we have to show the accounts receivable less the allowance for doubtful accounts. This is going to give us accounts receivable net of the allowance. And this is how it has to be presented on the balance sheet because this is what we're expecting to go through and collect. So generally, you're going to use one of two methods. You're going to use either percentage of accounts receivables, or you're going to be going through and using a percentage based on an aging of accounts receivables. These are both called balance sheet approaches. There is a percentage of credit sales. However, most people, it's more of an academic thing. It's not really used practically. So what happens with a receivable? So before I answer the bankruptcy question, I want you to kind of understand, what happens here with the life of a receivable. Well, we basically go through, we debit bad debt expense, and we're crediting this allowance for doubtful accounts, right? And just to kind of basically put as a little reminder, when we're going through and doing our little entries, right? And we always remember as well, assets are equal to our liabilities plus our owner's equity, ER, DC, right? So assets typically have debit balances. They're increased with debits, decreased with credits. Liabilities and equity accounts typically have credit balances, right? Because this is reducing my accounts receivable, we call this a contra asset account. So when I go over here to go through and record my entry, right, I'm debiting bad debt expense, right? We debit expenses, right? Debit expenses, and I'm crediting my allowance for doubtful accounts, right? So this is how we go through every year and record bad debt expense. Now, haven't gotten to this answer on the bankruptcy yet, but I want to explain this part of it first. When we realize that accounts receivable will not be collected, what we're going to go ahead and do is we're going to write off the receivable. Now, under the cash basis or under the direct write-off method, which is not GAAP, you would do bad debt expense and credit the AR directly. However, this is not GAAP, right? Very important. This is not falls under generally accepted accounting principles, right? This would be more of not even a cash basis, but again, it's not GAAP. So when we do a write-off of accounts receivable, right, basically what's going to happen is you're going to essentially go over here and debit allowance for doubtful accounts, and we're going to go ahead and credit accounts receivable because we need to go through and take that off of our books, right? So the way this is going to impact the allowance for doubtful accounts is over here is by a basically is by a debit to the allowance. And then over here with accounts receivable, you would basically be having a credit to write off accounts receivable. Okay, now this is also really important too. What happens when we collect a receivable that's been previously written off, right? So if we collect AR previously written off, we have to go first, basically say, okay, we have to reinstate the AR. We do this by reversing the curse. We're going to go ahead and debit AR, credit the allowance for doubtful accounts. And we'll call this Y. And then over here, collect the AR. Okay. So collecting the AR, we're going to debit cash and we're going to credit the accounts receivable. Right. So this is a really important thing in terms of what do we do if we've written it off and then we go back through and then later collect it. Right. So this is ultimately kind of go through the sequence here. Okay. Basically, we reinstate and then we're basically collecting. And then you'd have cash, which we'd throw over here. Cash is being debited. And then over here, the allowance for doubtful accounts is being credited. Okay, so just want to lay that all out just because I think it's really important to kind of go back to what my student was asking. And so when you look at this, a customer goes bankrupt. Let's talk about what happens in bankruptcy. When a customer goes bankrupt, there's two different ways they can go through it. It can be voluntary or it can be involuntary. There's a lot of different things with bankruptcy. And as you're going through and studying regulation, you can learn about all those different things, right? I am an attorney. I never took a bankruptcy class. I'm also a CPA. I do remember some of the different things, the way it goes. But generally what happens is when bankruptcy happens, what it's not going to do is you may get something, right? So remember, who gets paid out first in bankruptcy? Well, the attorneys do, of course, right? Then there's something I think with like involuntary gap creditors, but that's from 35 years ago, so that may have changed. Secured transactions. So, but with when a company goes bankrupt, they have to list out all their liabilities, right? So what would end up happening is they're going to say, okay, here are the liabilities we have. And then it basically goes through that after the attorneys are paid, after other people are paid, those liabilities will get paid. Remember, the owners of the company are going to pretty much get wiped out. So anybody that's owns common stock, they're gone in a bankruptcy, but the creditors may get something, right? And that's really the big question is how much are they going to be able to go through and receive? So when a bankruptcy is declared, right? So a customer goes bankrupt or they file for bankruptcy. It does not necessarily mean that we have to go through and write off the receivable, right? And this is a really bad, and as my student, basically, she was selecting this, which is you're writing it off. And that's kind of an evil question because really what you don't know was the receivable specifically reserved for? And we have to kind of make an assumption that it was not. So in the event of a bankruptcy, what should you go through and do? Because we don't know if we're going to be able to go through and collect everything, but we may collect something, the journal entry that was being suggested or operating expenses or what we would call bad debt expense, and then crediting the allowance for doubtful accounts actually seems like a decent way to go. It's not ideal. And the problem is like the information that the CPA review is kind of going through and doing is like, again, I don't know. I think that this is probably the best answer. This is clearly not the answer you'd want to give because this is not gap. You don't want to directly write off the receivable. It's just that a customer has gone bankrupt. You need to increase the allowance for doubtful accounts. So that's kind of how I would be going through and looking at it. And so for my student, I'm sorry. And yeah, it is a dirty question. So in any event, thank you for joining me here today. And I look forward to seeing you on future videos. Have a great one.